All right, well, I think we can go ahead and get started here. Hello, everyone. Good morning, good afternoon, or good evening, wherever it is that you find yourself in the world. Thank you so much for joining me today. My name is Victor Hart. I'm an account executive here with Demand-Driven Technologies, and I am so excited to walk through some basics about DDMRP and the benefits that they're delivering to companies around the world. So again, thank you so much, everyone, for joining today. Just a couple of housekeeping items here. Number one, everyone is on listen only mode, but if you do have questions that come to mind during the presentation today, we want to be sure to get those answered. So in the GoToWebinar tool, you'll find a questions function. So if you have questions that come up throughout the webinar, throughout the presentation, feel free to enter them in there, and we'll leave some time here at the end of the presentation to get those questions answered. And then if we run out of time for any questions, hopefully there's tons of questions coming in. So if we run out of time, then we'll be sure to follow up with you via email after the webinar. And then also for anybody that couldn't make it today, we will be circulating a recording of the presentation after the meeting. So keep an eye out for that later today or later this week. All right, and with that, we can go ahead and get into the content here. So in today's webinar, what I'm going to be covering is how enterprises around the world are utilizing DDMRP to both boost their on-time fill rate performance while simultaneously freeing up working capital via inventory reductions. So an agenda for us today here, I've got an introduction to our company, Demand-Driven Technologies, just a couple minutes there, and then I'll get into the limitations of the tool sets that have traditionally been on the market, such as traditional MRP, and then how DDMRP differs from that and how DDMRP helps to alleviate many of the challenges associated with traditional MRP. And then I'd like to get into the actual software demonstration. Replenishment Plus is our DDMRP software package. And so I'll walk through a high-level overview of how these DDMRP concepts can be incorporated into a software package to help companies scale these concepts throughout the enterprise. So as I said, we are Demand-Driven Technologies, and we offer a suite of demand-driven software solutions. Our entire focus as a company is to ensure that we are delivering tangible and sustainable results to our clients. We'll get into what those results can look like, but our singular focus is to ensure that our clients are receiving tangible and sustainable results from our software solutions. We were founded in 2011, and we were the first to market with a suite of solutions that are fully compliant with the Demand-Driven Institute's certifications. What we'll be looking at today is called Replenishment Plus. It was the first and remains the most widely adopted DDMRP tool around the globe. We've implemented with upwards of 100 clients on 6 different continents. And so we remain the global leaders in terms of demand-driven implementations. And we have a great network of implementation partners all around the globe to help us deliver really great service wherever in the world you find your business operating. Here are just a few of our clients. Some of these logos I'm sure you folks recognize, others you probably don't. Really 2 main takeaways that I like for folks to have from this slide here. Number one, this demand-driven methodology has been proven to be very successful amongst many different industries in the manufacturing and distribution space. And then number 2, the software itself is highly scalable depending on the size and complexity of your operations. So we can achieve great results with very small single location clients all the way up to huge global enterprises with more than 100 plants and anywhere in between. So regardless of the size and complexity of your operation, you can get really great results by implementing DDMRP. So let's talk about why DDMRP was developed in the first place. It was to overcome the limitations that are inherent with traditional MRP tools. As I'm sure you folks know, MRP is the primary planning logic that's used in all of the major ERP systems. It was introduced back in the 1970s, and the logic really hasn't evolved since then. And essentially, what MRP does is it relies on a sales forecast to drive our planning, our replenishment, and our production practices. The forecast is applied at the finished good level. The MRP engine blows that down through the bill of materials, and this is what we rely on to get our material signals. But there's a flaw that is inherent in the MRP logic, and that flaw is the assumption that the forecast is going to be accurate. Forecasts, by definition, are inaccurate. The more precise we try to be with our forecasts, the more profound that inaccuracy becomes. And so over time, what we see is by relying on that inaccurate forecast to drive our planning, that results with inventories being misaligned true market demand is. And we refer to this as a bimodal inventory distribution, which essentially means that at any given point in time, you've got some material that you've got too much of it, you've got capital tied up in material that's not moving, while at the same time, there are other materials that you're understocked on and are losing out on sales because you can't fulfill the orders or have to deal with expensive expedites or something like that. So basically, at any given point in time, companies relying on MRP have too much of the wrong items and too little of the right. What often happens then is planners and users don't trust the signals that they're getting out of their MRP engine, and they pull data outside of their systems and put that data into some kind of Excel spreadsheet that they've developed in an attempt to plan more accurately. And that has its own host of issues associated with it, from user error to different planners using different planning logic at other places or at varying spots within the organization, which leads to a lot of inconsistency. And so there are all kinds of issues associated with using worksheets and spreadsheets for that. And I thought this would be a good opportunity to just get some feedback from you folks on if this is an issue that you see in your business. And so I'm going to throw a poll out here and take a few seconds for everybody to answer. But the question here is very simple. Do you rely heavily on Excel spreadsheets in your inventory planning processes? All right, great. We've got some good results coming in. So I see 60% of you are saying yes, you rely heavily, about 10% say no, and the rest of you say sometimes you rely heavily. And that checks out with the responses that we often get. Many companies out there, some of the most mature large organizations around the world are still relying on these spreadsheets to help them plan. And so our goal is to help DDMRP alleviate that concern, get their planning out of spreadsheets back into a system that can automate it and scale it and whatnot. So DDMRP is a relatively new methodology. It was first really brought to market back in 2011, and essentially what it is a key fusion of key principles from MRP, lean, and theory of constraints. So we take aspects of each of these various different pillars of supply chain management and combine them into what we feel like is a best of breed planning solution. So how is it different? Well, whereas MRP systems rely exclusively on the forecast to drive their planning, DDMRP flips the switch, so to speak, and relies on real demand or real consumption coming in from the market. So rather than being primarily forecast driven, DDMRP is going to be driven by the demand that's actually coming in from the market. If we can leverage the real market demand, that's going to give us the best demand signal to be used in our planning practices, which is going to help us to much more accurately align inventories with what true market demand is. So in order to do this, we're going to leverage what are called DDMRP buffers. Now we apply these buffers at the item location level, and they're designed to ensure constant material availability. Anywhere that we assign a DDMRP buffer, we're expecting that buffer to align our inventory with the true market demand such that we'll constantly have that material available when we need it without having to carry a bunch of excess stock to ensure that. So there are 3 zones within a buffer. The green zone is what's going to set our average order size as well as our order frequency. So very commonly we'll use a minimum order quantity to size the green zone. That's not always the most appropriate way. Sometimes we can use an order cycle. Say if we want to create new supply orders on a weekly basis, we can use the green zone to support that cadence. The yellow zone is sized to cover usage over a lead time. So on average, over one given lead time, how much of an item are we going to be consuming? The 2 critical factors there that are going to be considered are the lead time, as well as what's called the average daily usage, which is simply a rolling historical average of our consumption. Multiply those 2 together, and that gives us our yellow zone size. As you can imagine, as our consumption changes on a daily basis, that average daily usage calculation is going to change in response to that, which is going to cause our buffer to resize itself in reaction to those fluctuations in demand. And then the red zone is the safety that's embedded within the buffer. The red zone protects me against variation, similar to a traditional safety stock, with one big key difference. Based on that average daily usage number, our red zone is going to be resizing itself on a daily basis as well. So the red zone protects us against variation. That could mean variation on the demand side, seasonality, things of that nature. That could be variation on the supply side. Maybe a supplier is inconsistent with their lead times. All of that variation we need to protect against, and the more variation there is with an item, the thicker the red zone needs to be to protect against that variation. So we apply these buffers at the item location level, and they're dynamic in nature, meaning that they're going to resize themselves on a daily basis. And then we'll know when to create new supply orders and for how much based on what's called our net flow equation. And the math here is really quite simple. My net flow is simply my current on-hand inventory plus any open supply minus any qualified demand. And demand is going to qualify if it's due to be fulfilled either today or in the past, or if it's what's called a qualified spike, which is firm demand that's due in the future, but it's due soon enough and the quantity is large enough that I want to go ahead and factor it into my net flow today. This net flow is essentially just a summary of everything that's flowing in and out of that location for that item. What do I currently have? What's on its way to me? And what do I need to ship out to the market? So the net flow is going to work in conjunction with the buffer to let us know if and when we need to create new supply orders. Each buffer zone is going to be resizing itself on a daily basis in response to my daily demand. And then the net flow position is going to start out at the top of the green zone. Over time, as we consume materials, this net flow is going to be decreasing with respect to the buffer. And then once it drops out of the green zone into either the yellow or the red zone, that's going to trigger an order recommendation with the quantity being enough to get our net flow back up to the top of the green zone. So you can see over time, my net flow decreases. Once it drops into the yellow zone, I place an order to get that net flow back up to the top of the green zone. And then we'll be able to monitor the health of our inventory levels based on the buffer as well. We can monitor where within the buffer does our inventory typically sit and make judgments as to whether we need to make adjustments to our buffer. Am I carrying too much inventory? Am I carrying too little? when we get in the software, we'll see how we can get visibility into that at the item level as well as at an aggregate level. So when we deploy DDMRP, these are the steps that are involved. And the first one, positioning. This means we need to determine where are we going to apply these buffers throughout our supply chain. We call it decoupling. Anytime we apply a buffer at an item, we can expect constant material availability, which then decouples that item from any variability that's occurring further upstream. Not necessarily is every item going to be buffered. The percentages vary wildly depending on what type of business you're in. Frequently we see 60, 70% of items buffered, something along those lines, but there's still going to be a place for make to order or buy to order items. And for some really low runners where we want some stock but don't really need to be strategically reacting to the market, we can use min-max settings to manage those items. So step one is determining where do we need to apply these buffers. Step two is configuring the buffer profiles that we're going to use. And a buffer profile is essentially a way to group like items together such that we don't end up with thousands of unique settings across these items. So items with similar lead time profiles and variability profiles will set up buffer profiles for each of those that's going to impact how reactive the buffer, specifically the red zone, is going to be to fluctuations in demand. A really steady runner, for example, doesn't need to have a really reactive red zone, whereas a highly variable item, its buffer needs to react much greater, and that's what buffer profiles allow us to do. Once we apply the buffer profiles, those buffers are going to be dynamically adjusting throughout time in response to fluctuations in demand, and the software will recommend items that need to be replenished based on their priority levels on where the net flow is within the buffer. So all of this comes together to deliver some really fantastic results. We talked about improving fill rates while freeing working capital. So our clients typically see service levels in the 97 to 99% range. That's the number one goal of DDMRP buffers, is to protect high service levels. But they've been able to achieve that while simultaneously reducing inventory levels on average in the 20 to 45% range, thus freeing up significant working capital to be invested back into other areas of the business. And we'll talk about as well some of our manufacturing clients using that strategic decoupling have been able to compress their cumulative lead times on their finished goods by as much as 80%. So again, our singular goal as a company is to ensure that we can deliver these types of tangible and sustainable results to our clients, and we consistently do so. We've got tons of case studies from many different industries. Here are just a couple from some prominent companies that you folks might be familiar with. If you'd be interested in seeing more, feel free to reach out to us. I've got tons of case studies that I could share with that would be relevant to your industry. So as I mentioned, we've got a full suite of demand-driven supply chain products. What we're going to be focusing on today is Replenishment Plus, which is our core DDMRP software, the world's most widely adopted DDMRP tool. We also have tools for demand-driven sales and operations planning, as well as finite scheduling and execution. So if you're interested in either of those aspects, feel free to let us know. But without further ado, I'm going to shift gears here and then jump into Replenishment Plus and show you how we can deliver these concepts in a software package. So I'm in Replenishment Plus now. This is a cloud-based solution that simply integrates with our clients' ERP systems. We can integrate with any modern ERP system, whether that's an SAP, an Oracle, an Infor, or whatnot. And we're hosted in the Microsoft Azure environment. And Microsoft has been a very good home to us over the years. They provide the reliability, the scalability, and the security to enable us to support clients of many different sizes all around the world. And to that end, Replenishment Plus has been translated into many different languages. So wherever you are in the world, it's highly likely that Replenishment Plus has been translated into a language that will work for you. So I'm at the home screen. My plan here today is to start by going kind of a bit into the details and looking at the calculations that are being made in the background of the system on a daily basis. Not a level of detail that a planner would want to go into for every part every day, but I think it's helpful to understand how the system is generating its recommendations. And then we can talk about how do we execute upon all of those recommendations. So at the home screen, if I'm a planner and I log into the home screen here, there's going to be really two windows that are my primary concern. Those are these planning priorities as well as the execution alerts. And so I'm going to start with the planning priorities. This is showing me all of my items sorted by priority based on where the net flow is within the buffer. So I've got two items here where the net flow is critically low within the red zone. I know I'm going to be placing some new supply orders for these items today. And then because that net flow is so low, I probably want to dig into a little bit more detail with those items to find out why has my net flow gotten so low? Is there a one-off event that's occurred that I don't need to worry about happening in the future? Or is there a longer term trend that I've failed to pick up on that would necessitate me making an adjustment to my buffer settings? I've got 4 items here where the net flow is just crossed into the red zone. 2 non-buffered items here. Those are going to be either make to order or buy to order parts. So anytime we have demand against a non-buffered item, Replenishment Plus will recommend a new supply order to satisfy that demand. I've got 6 items here where the net flow is in the yellow zone. So I'm going to have orders recommended for all of these items that are in red and yellow. I've got 8 items where net flow is in the green zone. So I'm in a good inventory position on those. I don't need to take any action against those items today. And then I've got 3 items here that are in blue. That means that the net flow is actually over the top of the green zone, indicating I have too much supply planned and can look for opportunities to reduce said supply. Maybe I have a work order scheduled next week that I don't actually need, and so I can cancel that order to free capacity for another higher priority item. Or maybe I'm oversupplied at my location, but there's another location that needs to be replenished. So rather than purchasing more for that location, I can simply transfer over to them. So Replenishment Plus here will give us visibility into where we've got too much supply, so we can look for opportunities to reduce that. I could click on any one of these individual tiles to open up just those specific items, but I'm going to click on my Workbench button here, and this is going to open up all of my items, again, sorted by priority based on where the net flow is within the buffer. There's lots of data that's available to be displayed here in the Workbench. Some of this data comes over directly from the client's ERP system. Some comes from the calculations here in Replenishment Plus. Every user can customize what data they're going to see displayed here. It's very easy to drag and drop these columns around. I can determine which columns I want to be displaying in here. I can filter around lots of data. So very easy for users to set this up however best fits their role. The way I've got mine set up is to sort all of my items by priority. I can see at what percentage of the buffer the net flow is currently residing. And then over here on the right, I see the raw math behind that net flow. So I can see what my current on-hand inventory is, plus any open supply that I have, minus any qualified demand. That gives me a net flow position of 14 today. Because this item's in the red zone, I'm going to be placing an order to get this net flow back up to the top of the green zone, which is at 110. And so that gives me a recommended reorder quantity of 96 units today. I can come into this buffer sizing tab, and this will give me a great visual representation of that. I can see how each of my zones are sized. and then where the net flow is with respect to this buffer. We can see that the net flow is way down in the red zone. So instantly upon looking at this, I know that I'm going to be placing an order to get this net flow position back up to the top of the green zone. I can also view my current on-hand inventory and compare that to what my expected average inventory is. We're never planning specifically to this expected average inventory, but it's useful for us to see that for benchmarking purposes. As of today, my average daily usage is 6 units, so we're consuming 6 units per day. Based on this expected average inventory, that's going to give me on average 7 days coverage for this item. If we want to get a bit more granular and see the actual transactions that are going into that net flow equation, we can come into our all activity tab, and this is going to show me all of the transactions that this item is currently sitting on. Anything in red or blue is being factored into the net flow. Red represents demand and blue represents supply. And then we've got these 2 spikes down here that are highlighted in red. Those are the qualified spikes that I talked about earlier that we're factoring into the net flow. It's demand that's due in the future, but we want to go ahead and factor it into our net flow today. The threshold that we typically set up, and it can vary depending on the client's environment, but typically we'll set the threshold that demand will qualify as a spike if it's due within the lead time for the item, and if the quantity is greater than or equal to 1/2 of the red zone. So for this item, I can see that my lead time is 10 days. My red zone is 30 units as of today. So any demand for 15 or greater due in the next 10 days is going to qualify as a spike. So we see that we've got 2 work order demands here that fit that threshold. There's another work order demand down here at the bottom that's for greater than 1/2 of the red zone, but it's not due within the next 10 days. So I don't need to worry about it yet. I can leave it sitting out in the future because something might change. Our buffer might increase in size such that once this work order falls within a lead time window, it's no longer greater than 1/2 the red zone. The other piece here that a planner might want to keep an eye on if they come to this level of detail is this running balance column. This is going to show me what my inventory position is going to be as these transactions come to fruition. And what I want to keep an eye out for is anytime this running balance goes to a negative quantity, such as it is today, that's going to indicate a stock out. So I can see if I'm stocked out today, which I am, as well as if I'm projecting any stock outs to occur in the future so that I can try to get ahead of those. But you don't have to come to this level of detail to view that data. Replenishment Plus monitors the running balance columns as well. And what you'll see a little bit later in the presentation is that the software itself will alert users if there are any types of these projected stock outs such that they can take the necessary action prior to that stock out occurring. We looked at the buffer sizing tab, which shows how is my buffer sized today. If I come to my analytics tab, this will show me a historical view of the buffer. So I'm looking at the last 6 months. You can adjust that time horizon as you need. And so this is showing me over the last 6 months, how have my buffers been sized on a daily basis. And this very clearly illustrates the dynamic nature of these buffers. Back here, and it looks like late January, is the highest point of this buffer. The top of the buffer is almost 200 units. Then the buffer starts shrinking itself. Down here at the valley, the top of the buffer is at about 120. So we're looking at about a 40% shift, and that's all being driven by the consumption of this item. Demand was at its highest point in January, and then it dropped off by about 40%, and the buffer shrunk itself in reaction to that drop off in demand. I can add my net flow line on here, and this clearly illustrates that the planner has been doing a good job of following the logic. every time that net flow position drops out of the green zone down into the yellow, the planner's done a good job of accepting the order that's recommended to get that net flow back up to the top of the green zone. And then I can add my on-hand inventory line here, and we can see that it follows that pattern to some degree. One lead time after an order's a recommendation is accepted, we'll see the on-hand inventory increase, indicating that we've received that order. And this view gives me a clear picture of how well my inventory has been performing over this time period. Have I been carrying an appropriate amount? Have I been carrying too much or too less, whatnot? So what we can see here is that as my demand dropped off, my buffer started to shrink itself. The on-hand inventory got pretty high with respect to the buffer, but that's perfectly okay. That's what the buffers are designed for. You'll notice we simply go a little bit longer without creating a new supply order, which allows us to get our inventory back down to where we want it. And so over time, our on-hand inventory is going to jump up near the green zone, cross into the green zone. Sometimes it's going to drop down and consume some of the red zone. All of that is perfectly fine. Just over time, what I'd want to see is my on-hand inventory fluctuating around the low to mid part of the yellow zone. That's going to give me, that's going to be indicative of a really well-performing, really healthy buffer. If I came to this view and I saw that my on-hand inventory was constantly near the top of the yellow zone or in the green zone, what that would tell me as a planner is that I'm carrying too much inventory. I can thin out my buffers to get my inventory a little bit leaner without really being at risk of a stock out. Whereas conversely, if my on-hand inventory was constantly near the bottom of the red zone, well, that would tell me that I'm being too risky. A spike in demand could come through and cause me to stock out. So I need to thicken up my buffers to build up a little bit extra protection to ensure that that spike in demand and that stock out doesn't occur. So I was curious, and I'm going to throw another poll out there for you folks, but I was curious if, given the systems that you currently have today, do you have this kind of visibility into where your inventory levels should be, and is it as easy as this to judge if you need to make any adjustments out there? So I just put another poll out there. We've got some votes coming in. Some people saying yes, some people saying no. And we'll wait just a few more seconds. All right, interesting. So we're pretty even. So that's interesting. The small majority saying you don't quite have the kind of level of visibility. Many of you, it seems like you do have that kind of visibility. So very interesting there. We can view this both at the part level as well as at the aggregate level. And so we'll show that here just a little bit later into the presentation. All right, so all of these transaction or calculations and whatnot, this is all automatically going on in the background of the tool every day based on the transactional information that's coming over from the ERP system. R+ will calculate the buffers, the net flow, and then make recommendations on what needs to be reordered and when. And then it's very easy for users to accept those recommendations. So to do so, I could simply start check marking these items, and you can see that R+ is keeping track of how many recommendations I've marked for approval. I can go one by one if I want to, or I could simply check mark this item and then click approve orders. What that's going to do is then move all of these items over into a pending orders table, where they're simply waiting for the ERP system to come and retrieve them to create the corresponding purchase orders, work orders, and transfer orders in the ERP system itself. And if I go back to my home screen here, we can see that in my planning priority section, all of the items that were in red or yellow have been moved down to green. So I've accepted all of my recommendations, which is great. That's my first goal on a daily basis, is to get those net flow positions back into the green zone, thus ensuring I remain in a healthy inventory position. Now, I went through and manually approved those items. A lot of our clients are moving to, at least on a subset of their items, setting up auto approvals. So for really, really high priority strategic level items, we can set it up such that whenever R Plus recommends an order, it automatically gets accepted and a planner doesn't have to interact with that item at all. They can focus on the kind of exceptions out there. So got that kind of functionality available in here as well. So planning priorities, what we've looked at so far, it's all been about where is the net flow within the buffer on a daily basis, meaning telling me what I need to buy, make, or distribute today, which is, in our opinion, the best way to plan for materials, but it's not a complete picture. There can be scenarios where our net flow is in a great position, but based on the timing of supply and demand, we might have some issues, specifically stock out issues, unless we take some kind of corrective action. This goes back to the running balance column that we looked at for that individual part. And so that's where our execution alerts come into play. There are three types of execution alerts here, and they're sorted by priority. The first one, the highest priority, being a current inventory alert. This is showing me items that I'm currently stocked out on. Stockouts obviously are bad. We want to avoid those if we can, but we'll never be able to entirely 100% eliminate them. So we want to be sure that we're alerted here on the home screen if we have any stockouts, so that we can go in, view those items, determine what's caused us to stock out, do we need to make any settings adjustments, and then how can we expedite some materials to get in and alleviate that stock out. So that's going to be our first execution alert. The second one here is a material synchronization alert. This shows me items that, while I'm not stocked out today, based on the supply and demand that we have in the system, I will stock out at some point in the future unless I take some kind of corrective action. So I can open up these items to illustrate that. So for this item that I just selected here, we're not stocked out today, but we've got some demand due in 10 days that is going to cause us to stock out, because that's due prior to any supply being available to us. So what I would want to do here is see, is it possible for me to expedite this PO, or is it possible to get any additional supply in prior to this work order demand being due to prevent me from having that stock out occur. As we can imagine, then if I fail to do anything, eventually this demand becomes due, at which point that item moves up the priority list here. It's no longer a material synchronization alert. It then becomes a current inventory alert because that stock out did occur. And then the last type of alert here is a projected stock out alert. This shows me items where there's no demand in the system that's going to cause me to stock out in the future. We don't have any future demand, but if my average daily usage continues at its current rate, I will most likely stock out at some point in the future. So I like to think of the projected stock out in the context of a business that does same day shipping. Because they're expected to ship every sale order out the same day, they don't have any orders due in the future that they have visibility into. So there wouldn't be anything there to trigger a material synchronization alert, but they do have a view of their average daily usage trend. And if that trend continues at its current rate, based on the open supply that we have out there in the system, we may stock out prior to that supply becoming available to us. So planning priorities show us what do we need to replenish today, based on the buffer and the net flow logic. And then the execution alerts give us visibility into where we might have stock out issues in the future so that we can take whatever corrective actions we need to today in order to prevent that from occurring. All right, so now what I'd like to go through, I want to show an example of, I talked about the strategic decoupling that occurs when we deploy DDMRP, and I want to tie that back into how can companies utilize DDMRP to ensure high service levels while freeing up working capital. And to do so, real quickly, I'm going to delete some of those orders that I made earlier. All right, then I'm going to go back into my workbench. I'm going to look at a make part for this example. All right, so we've got part FPA, which is a finished good. It's a manufactured part. So I'm going to take a look at FPA's bill of material here. And I'm going to expand this out. So for any make parts, the bill of materials simply gets ported over from the ERP system. So what we see here for part FPA would be the exact same BOM structure that's set up in the ERP system. And we can see that there are several different levels to this BOM. Any item that has this red, yellow, green icon is going to be a buffered item, meaning we're maintaining strategic stocking levels and we can expect constant material availability for that item. So FPA is a make to stock item for us. Anything with this gray icon indicates a non-buffered item, meaning either it's a make to order part like this subassembly SAE, or it's a buy to order part like this purchase part PPA. So what we can see with FPA here is that I've got a manufactured lead time of 10 days for FPA. So once I have all of the materials I need, it takes me 10 days to make FPA, but I've got a total R plus lead time, what we would call a decoupled lead time of 35 days. And that's all being driven by the longest non-buffered leg within my bill of material here. That's what this black circle next to PPA indicates. So PPA is the non-buffered part with the longest lead time here in this example. So anytime that we want to make FPA, the first thing that we need to do is order PPA. It takes 25 days to get to us. We still have our 10-day manufactured lead time, so that gives us a cumulative lead time, a total R plus lead time of 35 days. And based on that, we can see the buffer sizing and what our inventory levels on average for FPA would be. So the top of my buffer here is around 300 units. I've got the net flow of 202. That's in the yellow zone. So as of today, Replenishment Plus is recommending that I make about 100 additional units of FPA to get that net flow back up to the top of the green zone. And what we can see is that our expected average inventory for FPA is 85 units. And so on average, we'll have around 85 units of FPA in stock. What I can do then is see what would happen to my finished good here if I made the strategic decision to commit to keeping this purchase part PPA in stock. And so to do that, I'm going to go to my part editor and I'm going to create a buffer for PPA. I've already filtered for it here. So if I look in the details, I can see that it's non-buffered. I don't have any buffer here for this item yet. And for time's sake, I'm just going to add the first buffer that we see. Instantly upon adding that, we can see how the buffer for PPA is sized today. Obviously, I'm going to have an initial large supply order to get this net flow up from 0 where it is today up to the top of the green zone. But then moving forward, I could expect constant availability of this part based on its buffer. So I'm going to save that. And then I'm going to go back to FPA, and we can see that my current view is out of date. So we're going to update that. And here in my priority, we can see that FPA has disappeared. PPA is now a critical priority because I need that first supply order, but FPA is no longer in yellow. And if I filter for part FPA, got to filter for the part number here. Now we can see that FPA is in blue, the net flow is over the top of the green zone. So what happened? Well, if we look at the bill of material again, we can see that my total R+ lead time has dropped dramatically, and that's because we're now buffering PPA. We can expect constant availability of it, so we don't have to wait on that 25-day lead time. Now, my longest non-buffered leg is the subassembly SAE that only has a 4-day lead time. So anytime we want to make FPA, the first thing I have to do is build SAE, which only takes 4 days. I still have the 10-day manufactured lead time for FPA, which means that my cumulative lead time, my total decoupled lead time, has decreased from 35 days all the way down to 14. And we can see what impact that's had on my buffer sizing and my inventory levels. We can see that the buffer for FPA has changed quite dramatically, where previously the top of the buffer was up around 300 and net flow was in the yellow zone. Now the buffer has shrunk such that the top is around 130 units, and the net flow is so far over the top of the green zone that it's not even showing up on my chart here. So where previously R+ was recommending that we build around 100 additional units of FPA, now it's saying that we've got too much supply plan and we can look for opportunities to reduce that. And my expected average inventory has decreased quite dramatically as well. Previously, I expected to carry about 85 units on hand. That's dropped all the way down to 41 units. So very critically, two things that we've done here by strategically decoupling through the bill of materials. We've made ourselves more responsive to the market by dramatically compressing our cumulative lead time for this finished good, while simultaneously reducing the overall inventory levels that we need to carry here, so we can maintain that high service level while freeing up a lot of working capital that otherwise would have been tied up in this finished good. That's the power of decoupling, and this is just a simplistic example here. You can imagine what that would mean as we go through every single bill of material in the entire supply chain network and strategically place these buffers, what that impact would be on fill rates as well as inventory levels throughout the network there. All right, last thing I wanted to cover here before we get into some Q&A is I want to talk about reporting, because reporting is obviously very important. We've got some pre-built reports in the application. We also have a full business intelligence tool, so users can create their custom reports. Our implementation teams and our client success teams build custom reports for clients all the time. So chances are, whatever it is that you would want to report on, we could use the business intelligence tool to do so. What I want to look at though is called our buffer trend report. And this is how we gauge the overall success of any implementation of DDMRP, as well as the ongoing health of the environment. And so what we're looking here is an aggregate view of the entire organization. We can set up filters to be able to slice and dice that as needed, look at different planners, different locations, different material types, so on and so forth. What we're looking at here, this is a 2-axis graph. So on the left, it's going to show us what our distribution of parts are based on where the net flow is within the buffer. So we've got a little over 10% of our parts at the start of this time frame here where the net flow is in the blue zone, about 20% of the parts where net flow is in the red zone, and the rest some combination of green and yellow. What we would want to see over time is largely eliminating the red zone items here and then slowly eating through the blue items until eventually we wind up with mostly green and yellow, which is what we see in this example. Very common when we first implement with a client, we'll see a large percentage of their items in blue and a large percentage of their items in red. That's indicative of that bimodal inventory distribution. But by adhering to the DDMRP principles over time, we can largely eliminate those two, thus ensuring all materials are very closely aligned with what the true market demand is. Then I'll add my on-hand and target inventory levels back here. And on the right-hand side, this shows us what our overall inventory levels are. The black line is our target inventory levels, what we should expect to have on average. Purple line shows us what our actual inventories are. And so we can see here, we've got a very healthy system and environment. Our on-hand inventories are fluctuating around that target inventory level, showing me that we've got a very healthy environment here. So this chart is critical for us as a company to monitor for our clients to make sure that they are getting the results that they expect out of the software, and very useful for clients as well to judge on their own how successful their team is in utilizing the software. All right, well, that's everything that I had planned to cover with you folks today, so really appreciate everybody joining. If you have interest in exploring further whether DDMRP can make an impact in your business as unique environment, one thing that we can do, and we do for nearly every single client we work with, is what we call a DDMRP simulation. What that means is we can gather some historical data of your items, however many items you'd like to share with us, and then we can model how effectively these DDMRP buffers would have managed those items given the demand that you actually experienced in the past. So again, I've got my email there in the chat, which hopefully you folks have had a chance to jot down. So if you're interested in exploring that simulation, or if you're interested in discussing in any more detail how DDMRP could fit in at your specific organization, please don't hesitate to reach out to me. Would be more than happy to help on that front.